In September 2002, a Manhattan grand jury reviewed a set of invoices: a $6,000 shower curtain, a $15,000 umbrella stand in the shape of a dog, a birthday party on the island of Sardinia catered with an ice sculpture, and a budget that approached $2 million, roughly half of it charged to Tyco International. The line items themselves were unremarkable in the way that luxury is unremarkable. Expensive, but not by themselves criminal. What mattered was the ledger entry behind each of them. Every one of these expenditures traced back to a corporate account called the Key Employee Loan Program. The question the grand jury was assembling, and the question this episode answers, is structural. How does a relocation loan program designed to move executives between offices become a private credit facility that funds a chief executive's personal consumption and then erases the debt without anyone recording the forgiveness as compensation? Begin with the instrument, because the instrument is where the entire case lives. The Key Employee Loan Program at Tyco was, on paper, an ordinary corporate benefit. When a company asks senior employees to relocate, it commonly offers loans to ease the transition. The most common form of these is a relocation loan tied to the purchase of a residence near a new corporate office. An executive moved from one state to another at the company's request would face the friction of buying a new home before selling the old one. A company extended loan bridges that gap. The loan is documented, it carries a stated interest rate, and it is secured, typically against the property itself. When the relocation is complete or the employment ends, the loan is repaid. This is a benign and widely used mechanism. Tyco's program had a specific stated purpose. According to the SEC's enforcement record, the Key Employee Loan Program was established to encourage ownership of Tyco stock by senior employees and to assist them with the payment of taxes that came due when restricted stock vested. That is its second legitimate function. When restricted stock vests, the employee owes ordinary income tax on the value of the shares at vesting, even though the employee may not have sold any shares to generate cash. This creates a liquidity problem, a tax bill without the cash to pay it. A loan program that advances the cash to cover the tax, repaid as the employee chooses to sell shares over time, is a defensible compensation tool. It keeps executive equity intact and aligned with shareholders while solving the timing mismatch. So the program had two sanctioned uses. 1. Relocation. 2. The payment of taxes triggered by the vesting of Tyco restricted stock. Both were disclosed. Both were governed by program documentation. Both were the kind of thing a compensation committee approves and an auditor reviews. Now understand what the program was structurally. It was a pool of company cash, available on demand to a defined set of senior employees, drawable through a process that did not require the friction of an external lender. There was no bank underwriting each advance. There was no independent loan officer assessing whether a given draw matched an approved purpose. The authorization sat inside the company. And critically, the accounting treatment of a loan and the accounting treatment of compensation are fundamentally different. And that difference is the fault line the entire fraud runs along. Here is why the distinction matters. A loan is a balance sheet event. When a company lends money to an employee, it records a receivable, an asset, an amount the company expects to be repaid. There is no expense. There is no charge to earnings. The company's income statement is untouched. Compensation is an income statement event. When a company pays an employee, whether in cash or by forgiving a debt the employee owed, that is an expense. It reduces reported earnings. It must be disclosed in proxy statements as part of named executive compensation. It is subject to the scrutiny of the Compensation Committee, the board, the shareholders, and the tax authorities, because compensation is taxable to the recipient and deductible to the company in defined ways. So the structural arbitrage is this. If you can characterize a transfer of cash to an executive as a loan rather than as compensation, you achieve three things simultaneously. First, you keep the expense off the income statement, so reported earnings look higher. Second, you keep the amount out of the proxy statement, so the disclosed compensation of the executive looks lower than the value he is actually receiving. Third, you defer or avoid the tax consequence to the executive, because a loan is not taxable income, while compensation is. A loan that is never meant to be repaid is, in economic substance, compensation. A loan that is forgiven without being recorded as compensation is, in accounting substance, a falsification. The Key Employee Loan Program gave Tyco a mechanism whose legitimate form was a loan and whose abused form was disguised, undisclosed, untaxed pay. The fraud did not require inventing a new instrument. It required taking an existing instrument and detaching it from the two purposes it was authorized for. That detachment is the architecture. Walk through it in steps. Step 1. The expansion of permitted use. The program was authorized for relocation and for stock vesting taxes. The SEC's complaint established that the chief executive, L. Dennis Kozlowski, drew on key employee loans for purposes far outside those bounds. The record shows the loans funded the acquisition of fine art, yachts, residential real estate, beyond any relocation purpose, jewelry, and personal investments. The program was treated as a revolving line of personal credit. The first structural move is simply that the scope of draws expanded to cover personal consumption, while the accounting characterization remained loan. Step 2. The scale. According to the SEC, Kozlowski took hundreds of millions of dollars in such loans over the relevant period. The figure the Commission cited for relocation program borrowing alone ran to amounts that bore no relationship to any relocation. The complaint described tens of millions characterized as relocation loans in connection with a New York residence and properties in Florida, where the relocation rationale did not support the magnitude. The scale matters structurally because at sufficient volume the receivable on Tyco's books represented a material asset that was, in substance, never going to be collected. An uncollectible receivable carried at full value overstates the company's assets and overstates its earnings, because the eventual write-off, when it should have been taken, would have been an expense. Step 3. The conversion through forgiveness. This is the load-bearing step. Drawing a loan is reversible. The executive could, in theory, repay it. What converts the loan irrevocably into compensation is forgiveness. The SEC's enforcement record established that large portions of these loans were forgiven. The Commission described a program internally referred to as a relocation loan forgiveness, and separately, benefits under which loan balances were simply eliminated. When a loan is forgiven, the receivable disappears from the balance sheet. Under correct accounting, the disappearance of that asset must be matched by a charge somewhere. Either it is a compensation expense recognized on the income statement and disclosed in the proxy, or it is a loss. The record establishes that Tyco recorded neither in the manner required and did not disclose the forgiveness as compensation to shareholders. Step 4. The unauthorized authorization. For forgiveness to be legitimate, someone with authority must approve it, and it must be disclosed. The SEC alleged, and its enforcement record reflects, that certain of these forgiveness benefits were never approved by the Compensation Committee of Tyco's board. The complaint described a relocation program under which loans were forgiven without proper authorization, and a separate Tycom bonus, and other benefit programs through which compensation flowed without board approval and without disclosure. The structural significance is that the gatekeeping body that exists precisely to approve and disclose executive compensation was bypassed. The forgiveness happened inside the management layer that controlled the program, not at the board layer that was supposed to govern it. Step 5. The layering with a second mechanism. The loan program did not operate alone. The SEC's complaint described additional related vehicles. One was the Relocation Loan program itself, abused as described. Another was a set of unauthorized bonus programs. The record describes a scheme in which Kozlowski and the Chief Financial Officer, Mark Swartz, granted themselves and others unauthorized bonuses, some of which were used to repay or offset the very key employee loans they had drawn. Follow the circularity. The executive draws a loan characterized as an asset on Tyco's books. Later, an unauthorized bonus is granted. The bonus is applied to forgive the loan. If the bonus itself is not disclosed and not properly authorized, then the entire round trip has moved company cash into personal consumption while recording, at each stage, something other than compensation. The loan looked like an asset. The forgiveness looked like a routine program benefit. The bonus that funded it looked like nothing at all because it was not disclosed. Step 6. The proxy effect. Every public company must disclose the compensation of its named executive officers in its annual proxy statement. The figures shareholders see are meant to represent total pay. Because the loans were not characterized as compensation, and because the forgiveness and unauthorized bonuses were not disclosed, the proxy statements understated the actual value Kozlowski and Swartz received. The SEC's complaint stated this directly. The defendants failed to disclose to shareholders the loans, the loan forgiveness, and the compensation they received. Structurally, the proxy is the shareholders' primary window into how much the people running the company are paid. The loan program darkened that window. Shareholders approving executive pay and analysts modeling the cost of management were working from numbers that excluded a material portion of what management actually extracted. Draw the structure as a whole. At the center is a pool of corporate cash. Around it, 3 permitted-looking conduits: relocation loans, stock tax loans, and bonus programs. Through these conduits, cash moved to executives. The cash was characterized as loans, which kept it off the income statement and out of the proxy. Then the loans were forgiven, often through unauthorized bonuses, which converted them into compensation in economic substance, while the books continued to reflect either an asset or nothing at all. The forgiveness was not approved by the Compensation Committee in the cases the SEC identified and not disclosed to shareholders. The shower curtain, the umbrella stand, the Sardinia party. These were not the fraud. They were the downstream spending. The fraud was the ledger architecture that allowed corporate cash to fund them while the company's financial statements and disclosures said it had not happened. Now, the question that any forensic review must answer. This was a large public company. It had auditors. It had a board. It filed with the SEC. Why did the structure persist? Begin with the nature of the instrument as a detection problem. A loan, properly documented, is one of the least suspicious entries on a corporate balance sheet. An auditor reviewing a receivable from an employee under an established board-approved program is looking at something that, on its face, conforms to a sanctioned policy. The key employee loan program existed. It had documentation. It had a legitimate purpose. An auditor's first question, does a program exist and is it authorized, returned a clean answer. The abuse was not in the existence of the program, but in the use of individual draws and in the forgiveness of balances. Detecting that abuse required not confirming that the program existed, but reconstructing what each draw was actually used for and whether each forgiveness had been properly approved and disclosed. That is a far deeper inquiry than confirming a receivable's existence and valuation. Consider the valuation question specifically. An auditor is required to assess whether a receivable is collectible. If the loans had been visibly uncollectible, an auditor should have demanded a write-down, and the write-down would have surfaced the economic reality. But the loans were not formally in default. The borrower was the chief executive, a man of substantial net worth on paper, much of it in Tyco stock. A receivable from a wealthy employed executive does not present as impaired. The collectability test, applied mechanically, returned the wrong answer because the loans looked collectible, even though, in the cases that were forgiven, there was never an intention to collect. Intention is not visible in a ledger. The mechanism exploited the gap between the documented form of an asset and the undocumented intention behind it. Now, the governance layer. The Compensation Committee is the body responsible for approving executive pay and the forgiveness of executive loans. The SEC's complaint established that certain forgiveness benefits were not authorized by that committee. Structurally, this means the control that should have caught the conversion of loans into compensation was circumvented rather than deceived. A control that is bypassed does not generate a red flag because it never sees the transaction. The forgiveness was processed at a level below the committee. For the committee to have caught it, the committee would have had to be actively reconstructing the program's activity on its own initiative, rather than reviewing the items management presented to it. Boards generally review what management brings them. When the relevant transactions are routed around the board's diligence, however earnest, does not reach them. Consider the position of the Chief Financial Officer. The CFO is, in the ordinary architecture of a public company, a primary check on the chief executive's financial conduct. The CFO certifies the books. The CFO is the gatekeeper between management's wishes and the recorded reality. In this case, the SEC alleged that the Chief Financial Officer, Mark Swartz, was a participant in the scheme rather than a check on it. When the officer responsible for the integrity of the financial statements is aligned with the conduct rather than opposed to it, an entire layer of internal control collapses, because that layer's function is to refuse, and it does not refuse. A jury subsequently found both Kozlowski and Swartz guilty on state charges arising from this conduct. For purposes of the verification chain, the structural point is that the internal check most proximate to the fraud was not independent of it. Now, the external analysts and rating agencies. Tyco, in this period, was a conglomerate executing a rapid program of acquisitions. Its reported earnings were the focus of the market's attention. Analysts modeled the company's growth, its acquisition accounting, its cash flow. The loan program abuse did not distort the company's revenue or its operating results in a way that would have shown up in the metrics analysts watched most closely. It was a compensation and disclosure failure off to the side of the operating story. The amounts, while large in absolute terms, were small relative to a company of Tyco's revenue. Analysts looking for the next acquisition's effect on earnings were not reconstructing the chief executive's personal loan balances. The fraud lived in a part of the disclosure that the market's analytical machinery did not stress test. What would have had to be true for earlier detection? Several conditions, each demanding. First, an auditor or examiner would have had to test not the existence of the loan program but the conformity of individual draws to authorized purposes, tracing where the money actually went. Second, someone would have had to verify that every loan forgiveness had been approved at the compensation committee level and disclosed in the proxy, cross-checking the forgiveness ledger against committee minutes and proxy filings. Third, the chief financial officer would have had to be independent of the conduct, so that the certification of the financials carried the assurance it is supposed to carry. None of these conditions held. The mechanism survived not because it was undetectable in principle, but because the specific verification steps that would have detected it were not the steps anyone was performing, and the person best positioned to perform them was inside the scheme. The exposure, when it came, did not come from the audit, the board, or the analysts. It came from an unrelated tax inquiry. The trigger was art. The record shows that the New York County District Attorney's Office in 2002 was investigating whether sales tax had been evaded on the purchase of paintings. Kozlowski had acquired valuable artwork. The question the prosecutors pursued was whether the arrangement had been structured to avoid New York sales tax, in part by creating the appearance that the art was being shipped out of state when it was in fact destined for a Manhattan apartment. The first charge against Kozlowski was a sales tax evasion charge relating to the art, announced in June 2002. This is the structural irony of the unraveling. A multi-$100 million disguised compensation scheme was first pulled into daylight by an inquiry into the tax on paintings. Once prosecutors and regulators followed the money behind the art and the other personal expenditures, the key employee loan architecture became visible. The invoices the grand jury reviewed, the shower curtain, the umbrella stand, the Sardinia party, were not the crime, but they were the trail. Each expenditure raised the same question: where did the money come from? The answer, repeatedly, was the loan program and the unauthorized bonus mechanisms. Following the personal spending led directly to the corporate accounts that funded it, and once investigators reached those accounts, the forgiveness and the disclosure failures were exposed. In September 2002, the SEC filed its civil enforcement action against Kozlowski, Swartz, and Tyco's former general counsel, Mark Belnick. The complaint laid out the loan program abuse and the disclosure failures in structural terms. It alleged that Kozlowski and Swartz had taken hundreds of millions of dollars in loans and compensation that were not authorized and not disclosed, and that they had concealed this from shareholders. The SEC's action established the mechanism in the public record: the loans, the forgiveness, the unauthorized bonuses, the failure to disclose. In parallel, the Manhattan District Attorney brought state criminal charges. The first trial of Kozlowski and Schwartz ended in a mistrial in 2004. A second trial followed. In 2005, a jury convicted both men of grand larceny, conspiracy, securities fraud, and falsifying business records, among other counts. The convictions were affirmed on appeal. For purposes of this review, the jury's verdict establishes the facts. The conduct was not merely a disclosure dispute, but, as the jury found, the theft of corporate funds and the falsification of records. Walk through how the mechanism collapsed once exposed, because the collapse is itself instructive about the structure. The defense of the loan program rested on its form. These were loans, documented, under an authorized program. The prosecution's task was to show that the form was a fiction, that the loans were never intended to be repaid, that the forgiveness was unauthorized, and that the result was the conversion of corporate cash into undisclosed personal compensation. The evidence that did this work was the same evidence that had made the fraud possible: the ledger. The key employee loan account recorded the draws. The forgiveness entries recorded the conversion. The proxy statements recorded what shareholders were told. By placing these three records side by side, the prosecution demonstrated the gap between what the company received in cash from its executives, which was nothing, and what its executives received from the company, which was hundreds of millions. The instrument that had concealed the fraud became the instrument that proved it, because a loan, once forgiven without authorization and without disclosure, leaves a documentary trail that points in only one direction. Tyco itself, under new management, became a participant in establishing the record. The company cooperated with investigators, restated relevant disclosures, and pursued recovery of amounts taken. The SEC's enforcement action against the company was resolved, and the company implemented governance reforms. The structural point is that once the new management reconstructed the program's activity, the same verification steps that had not been performed earlier were performed, and they produced exactly the result the earlier absence of those steps had hidden. The fraud was not undetectable. It was undetected until someone performed the reconstruction. The amounts recovered and forfeited, and the restitution ordered against Kozlowski and Schwartz ran into the hundreds of millions of dollars. The SEC's settlement with the individuals included disgorgement and penalties. The men served prison terms before being released on parole. For the forensic record, the resolution confirms the characterization. The transfers were not loans the men were entitled to keep, but corporate funds they were ordered to return, which is the legal system's way of stating that the loans were, in substance, theft dressed as credit. What does this case establish about the mechanism? It establishes that the boundary between a loan and compensation is not a matter of paperwork, but a matter of intention and authorization, and that this boundary is exploitable precisely because intention is not visible in a ledger. A loan and a gift can be recorded identically at the moment cash changes hands. What distinguishes them is whether repayment is expected, and that expectation lives in the minds of the parties, not in the entry. The key employee loan program demonstrates that an instrument whose legitimate form keeps cash off the income statement and out of the proxy is, by that same property, an instrument that can move cash to executives invisibly if the discipline of repayment and the discipline of disclosure both fail. The instrument did not have to be invented. It had to be detached from its authorized purposes and from the controls that governed it. It establishes a second structural point about gatekeeping. The Compensation Committee, the auditor, and the Chief Financial Officer were all present. The fraud survived because each was bypassed, deceived, or aligned. The committee did not approve what it never saw. The auditor confirmed a program that existed and a receivable that looked collectible. The Chief Financial Officer, the natural check, was a participant. A control structure is only as strong as its least independent node, and when the executive who controls the program also controls or co-opts the layers meant to check the program, the structure provides assurance without providing protection. The case produced concrete regulatory consequence. The conduct at Tyco, alongside the contemporaneous failures at Enron and WorldCom, formed part of the factual backdrop against which Congress enacted the Sarbanes-Oxley Act of 2002. Among that law's provisions is a direct response to the loan mechanism. Section 402 of the Act prohibits public companies from extending or maintaining personal loans to their directors and executive officers, with narrow exceptions. The structural lesson Congress drew was not about character. It was about the instrument. The prohibition removed the conduit. If a public company cannot lend to its executives, the loan-to-compensation arbitrage at the center of this case is foreclosed at the source. Sarbanes-Oxley also strengthened the certification requirements for chief executives and chief financial officers, addressing the second structural weakness, the alignment of the certifying officer with the conduct rather than against it. The forensic finding is this: the key employee loan program was a legitimate instrument whose accounting and disclosure properties made it a vehicle for undisclosed compensation when its draws were detached from authorized purposes and its forgiveness was detached from authorization and disclosure. The fraud worked because a loan is an asset and compensation is an expense, and the difference between them in the moment of the transfer is invisible. It was exposed because forgiveness, unlike a draw, leaves a permanent mark, and because an unrelated tax inquiry pulled the trail into view. The regulatory response did not appeal to better behavior. It removed the instrument. That is where this review ends, with a prohibition, not a verdict on human nature.